Hey everyone, welcome back to my mortgage update for the month of March. Today we're going to be diving into interest rates once again and where they're headed for the rest of the year. There's a lot to cover in this video, obviously because of the tariffs and everything like that. But if you get some value from this, please feel free, hit the like button. It really helps me know that these videos are going out to people and you're actually listening. So let's get right into it. So getting this started, the three most important factors this year with regards to interest rates are going to be tariffs, the biggest one, inflation, and then GDP. Moving forward this year, if there are data points that you want to stay up to date with, it's these three that I recommend that you do. Moving forward in this video, I'm going to give you a forward-looking forecast for all three of those determinants, and we will be able to extrapolate how these determinants will affect interest rates going forward. It's going to be very, very interesting to see. So BMO is going to give us good insights on what we can expect with tariffs in place. Now, at this point, please feel free to pause and take a picture of the QR code on your screen. It's going to bring you to the article that I've referenced all this data from. So all of these, touch points that I'm going to be referencing, you'll be able to find it in the article, and I think it'll be good for you guys moving forward. But first of all, setting the tariffs aside, what can we expect with our other two factors, inflation and GDP? Well, for GDP, BMO expects that it's going to retract by about 1.5%, meaning that for the year of 2025, they're expecting total growth of about 0.5%. This reduction in GDP growth is an indicator that lower interest rates are on the horizon to help stimulate the economy, to help stimulate more GDP growth in the event of some retractions. Now, next for inflation, it was 1.9 in January, and it's expected to be 1.9 for the rest of the year. And with inflation staying in check, it certainly opens the door for the Bank of Canada to ease its interest rate policy even more without the threat of, inflation coming back further. Now, for the main event, tariffs, there's no historical precedence for this scenario, but BMO expects the Bank of Canada to cut interest rates more aggressively. Now, I was able to take a look at their pre-tariff scenario and their, post-tariff scenario. So, let's take a look at the differences that we can expect in a world where there are tariffs. So this chart is an interesting chart. It's going to be all of the big six banks, and they forecasted where they think rates are going to be at the start of the year. Now, they released this in January 2025, and it doesn't take tariffs into consideration as much as one should now that, they're obviously in place. But, I just want to highlight the first row, which is BMO. These guys are expecting BMO, they're expecting interest rates to drop from the first quarter 2025 all the way to the fourth quarter 2025 by 50 basis points. They're expecting a cut in April and then a cut in July. And that was all they were expecting for the start of the year. Now, in a tariff scenario, what are they expecting? The two charts that I have here are comparisons of what to expect the Bank of Canada to do in either scenario. We got no tariffs on the left and tariffs on the right. As you can see, if the tariffs were to remain in effect, let's say for a year, then the market's expecting 6 consecutive 25 basis point cuts from March till October. And that's quite significant, folks. Now, the key word here is if. It's no surprise that these tariffs are political, meaning that the no tariff scenario is still a likely outcome. We won't know about what more to expect until this whole situation plays out and we have more guidance. But, these two charts are going to ensure that you and your clients know what to expect with regards to rates, with regards to housing for the rest of the year. So keep both of these charts in mind as we continue throughout the rest of the year, and you guys will be set regardless. Now, since these tariffs have been in place, the leading indicator that we can look at to see how the market is reacting is going to be bond yields. Now, you'll be able to take a look at this graph from left to right. right being the present, bond yields are at the lowest they've been in over a year. Bond yields continue to fall. I expect that this is going to result in fixed rates decreasing in a week or so by the tune of about 10 to 25 basis points. So expect some immediate relief, especially if the tariffs continue to remain in effect. Now, the last chart that I'm going to present to you guys here is the year to date for 2025 on bond yields. As you guys will be able to see, bond yields are down by about 50 basis points. And that's going to result in tangible rate decreases for mortgages. And again, forward looking, in the next 1 to 2 weeks, we are expecting more rate decreases on the horizon, around 10 to 25 basis points. But let's not just take my word for it. What I want to share for you guys is a clip from the Bank of Canada, Governor Tiff Macklem, actually getting a question from a reporter from the Financial Post asking how they're going to be utilizing interest rates in the event of a tariff war. I typically will watch the entire Bank of Canada meetings, and I wanted to highlight a really important part that I think you guys would like to see.
So, what are we going to be doing? Well, we're going to be assessing the relative weight of those two. And if the weakness on the economy that comes through as a result of tariffs and the downward pressure that's putting on inflation comes faster and is bigger than the upward pressure, then monetary policy, I expect, will be focusing more on supporting growth. On the other hand, if the inflationary pressures come through faster and are bigger, monetary policy is going to have to be more focused on guarding against persistent inflation. What are we doing right now? We're running different scenarios.
Running different scenarios, kind of like we were able to present here earlier on in the video. But like I said, keep in mind those scenarios because that's what the Bank of Canada is going to be keeping in mind as well. Obviously, as Tiff Macklem said, they're going to be gauging things from two ends of the spectrum. An inflationary end of the spectrum where they have to keep interest rates high, and one where monetary policy needs to stimulate the economy. Based off of what I'm seeing in the market, most are estimating that they will have to stimulate the economy by keeping rates decreased. But you guys heard it from the source. He's definitely going to be, allowing himself to the room to go both ways, just so that it's no surprise to the market when he does make those moves. What do I think personally? I think personally we're going to see a cut in March. And that's going to be allowing further rate decreases. Hopefully we get to about 3.5 by the middle of the year for fixed rates. But you guys can see these fixed rates up on your screen right now on a conventional 30-year mortgage, 3-year fix. You can expect about 4.3. The next rate meeting is coming up March 12th, so keep your eyes on that. What do you guys think is going to be happening? You think they're going to cut by 25 basis points like expected, or do you think they're going to go for more? Leave it down in the comments. Send me a like. It really helps me out. Thanks for watching the video, guys. Thanks. Bye.